afternoon. Good afternoon and welcome to the National Press Club. My name is Monroe Carmen. I'm the Vice President of the Press Club and Editor-at-Large at Bloomberg Business News. I'd like to welcome club members and their guests in the audience today, as well as those of you watching on C-SPAN or listening to the program on National Public Radio or the Global Internet Computer Network. Before introducing our head table, I would like to remind our members of upcoming speakers. On Tuesday, October 11th, Jane Alexander, Chair of the National Endowment of the Arts, will present a speech entitled The American Community Connecting Through the Arts. On Wednesday, October 12th, Ralph Reed, Executive Director of the Christian Coalition, will talk about the emerging faith factor in American politics. And on Thursday, October 13th, Arthur Levitt, Chairman of the Securities and Exchange Commission, will talk about taking the message out of the marketplace, the SEC's Consumer Education Campaign. Audio and videotapes of Press Club luncheons are available through the National Press Club Library or by calling 1-800-500-9911. If you have any questions for our speakers, please write them on the cards provided at your table and pass them up to me. I will ask as many as time permits. I'd now like to introduce our head table guests and ask them to stand briefly when their names are called. From your right, Stephanie Overman of HR Magazine, Edward Kane of Knight Ridder Financial News, Greg Robb of AFX News, Robert Brusca, Chief Economist at Nikko Securities, Stan Kroc of Business Week, Carolyn Lynch, the spouse of our speaker. All right, fine, go ahead. Vanita Anand of Pensions and Investments and member of the National Press Club who arranged today's luncheon. James Johnson, Chairman and CEO of Fannie Mae. Representative Edward Markey, Democrat from Massachusetts and Chairman of the House Subcommittee on Telecommunications and Finance. Lee Shepard of Tax Notes. David Weiss of The Washington Post. I'd also like to thank the staff members who organized today's lunch: Melissa Bender, Sherry Burton, Melanie Abdo-Dermott, and Jeff Tarbell. There's one thing you have to understand about our luncheon speaker today. Sometimes Peter Lynch may look as if he's going out for a sandwich at lunch. But what he's really doing is trying to figure out if Bob and Penn is a good investment. Lynch is always on the prowl for a good stock. One friend says that if you came to him with the best widget in the world and the Queen of England were sitting on one side of him and Cindy Crawford on the other, he would ignore them and inundate you with questions about the widget maker's management. His intense interest in anything that would produce a good return is one reason few people have had a greater impact on the investment world. In fact, the market dropped about 40 points one day when a compressed version of his market views went over an online computer service. He had said that if you looked at markets over a 20-year period, there were ups and downs. But that got translated into the headline, Lynch predicts market correction. But the Lynch legend is based more on what he has done than on what he has said. He helped transform investing by giving individuals access to a mutual fund that steadily outperformed the market and competitors for more than a decade. His performance at Magellan earned the appreciation, pun intended, of many Americans who paid for their kids' college through Magellan's growth. When Mr. Lynch became portfolio manager for Magellan in 1977, it had less than $20 million in assets. By the time he retired in 1990 to spend more time with his family, Magellan was the largest mutual fund in the world, with more than 1 million shareholders and approximately $14 billion in assets. It's easy to see what attracted shareholders to Magellan. The share price had risen 28-fold since Mr. Lynch had taken the helm, with annual increases averaging 29%. Even more remarkable, though big funds are supposed to have more difficulty than smaller funds in outperforming the market, in the last 5 years of Mr. Lynch's stewardship, Magellan outperformed 99% of all stock funds. Given his golden touch, excuse me, it's no surprise that Mr. Lynch's books, One Up on Wall Street and Beating the Street, I have one here, have been bestsellers. His message is really rather simple, if he'd allow me to paraphrase it. He thinks anyone can get rich in the stock market if they do two things: use their powers of observation and do their homework. Still, Mr. Lynch knows how to lose money, too. The Magellan Fund lost about $2 billion, maybe more, in a single day in 1987 when the stock market crashed. I personally hosted Mr. Lynch once before, a few years ago, and he was discussing his views on the stock market, and I asked him to give me some examples of stocks he liked at the time. He suggested Sbarro, the Italian fast food chain, whose price rose remarkably over the past few years. And he also recommended Texas Air, which dropped, crashed to nothing. So I think he would agree that he is not infallible, too. A native of Boston, Mr. Lynch is a 1965 graduate of Boston College and received his MBA from the University of Pennsylvania's Wharton School of Business Administration. He served as a lieutenant in the Army before coming to Fidelity in 1969. He currently serves as vice chairman of Fidelity, sits on the boards of Morrison Knudsen and W.R. Grace, and is heavily involved in charity work. Will you please welcome Mr. Peter Lynch.
Thank you very much. It's a pleasure to be here. I love this town, and it's a thrill to be here with Jim Johnson, who did so much for Fannie Mae, and that was the greatest single stock of my life, and it's still my largest position. And anybody wants to talk after about how to make money, I'll tell them how to buy more Fannie Mae. And now I've added Freddie Mac to the list too. And Congressman Ed Markey, who went to Boston College and also Boston College Law School, and has done a great job in Congress for everybody in this country, but especially the people in his districts in Massachusetts. But the great honor is to have my wife Carolyn right here, my sweetheart, my great stock picker, who found legs and a bunch of other good stocks. So what I'm going to try and do today, briefly, is, I don't know what I'm supposed to do with this gavel. I've never had one of these things before. I'm going to try and say some words on the things I've used over the years when I was an amateur, when I ran Magellan. I still use today. I think they make sense. I think they make a lot of sense for investors, and I frankly think it's a tragedy in America that the small investor has been convinced by the media, the print media, the radio, the television media, that they don't have a chance. The big institutions with all their computers and all their degrees and all their money have all the edges, and it just isn't true at all. And when they're convinced, when this happens, when this occurs, people act accordingly. When they believe it, they buy stocks for a week, and they buy options, and they buy the Chile fund this week, and next week it's the Argentina fund, and they get results proportionate to that kind of investing. And that's very bothersome. I think the public can do extremely well in the stock market on their own. I think the fact that institutions dominate the market today is a positive for small investors. These institutions push stocks on usual lows, they push them on usual highs. For someone that can sit back and have their own opinion, know something about an industry, this is a positive. It's not a negative. So that's what I want to talk about. And the single most important thing to me in the stock market for anyone is to know what you own. I'm amazed how many people own stocks. They would not be able to tell you why they own it. They couldn't say in a minute or less why they own it. Actually, if you really press them down, they'd say, the reason I own this is the sucker's going up. I mean, that's the only reason. That's the only reason they own it. And if you can't explain, I'm serious, you can't explain to a 10-year-old in 2 minutes or less why you own a stock, you shouldn't own it. And that's true, I think, about 80% of people that own stocks. And this is the kind of stock people like to own. This is the kind of company people adore owning. This is a relatively simple company. They make a very narrow, easy to understand product. They make a 1 megabit SRAM, CMOS, bipolar risk, floating point data I/O array processor with an optimizing compiler, a 16 dual port memory, a double diffused metal oxide semiconductor monolithic logic chip with a plasma matrix vacuum fluorescent display. It has a 16-bit dual memory. It has a Unix operating system, 4 whetstone megaflop polysilicon emitter, a high bandwidth, that's very important, 6 gigahertz, double metallization communication protocol, an asynchronous backward compatibility, peripheral bus architecture, 4-wave interleave memory, a token ring interchange backplane, and it does it in 15 nanoseconds of capability. Now, if you own a piece of crap like that, you will never make money. Never. Somebody will come along with more whetstones or less whetstones or a bigger megaflop or a smaller megaflop. You won't have the foggiest idea what's happened. And people buy this junk all the time. I made money in Dunkin' Donuts. I can understand it. When there was recessions, I didn't have to worry about what was happening. I could go there and people were still there. I didn't have to worry about low-priced Korean imports. I mean, I just didn't have, you know, I can understand it. And you laugh. I made 10 or 15 times my money in Dunkin' Donuts. Those are the kind of stocks I can understand. If you don't understand it, it doesn't work. This is the single biggest principle. And it bothers me that people are very careful with their money. The public, when they buy a refrigerator, they get a Consumer Reports. They buy a microwave oven, they do that. They ask people what's the best kind of radar range or what kind of car to buy. They do research on apartments. When they go on a trip to Wyoming, they get the Mobile Travel Guide, or California. When they go to Europe, they get the Michelin Travel Guide. People will hear a tip on a bus on some stock, and they'll put half their life savings in it before sunset, and they wonder why they lose money in the stock market. And when they lose money, they blame it on the institutions and program trading. That is garbage. They didn't do any research. They bought a piece of junk. They didn't look at the balance sheet, and that's what you get for it. And that's what we're being driven to, and it's self-fulfilling. The public does terrible investing, and they say they don't have a chance. It's because that's the way they're acting. I'm trying to convince people there is a method. There are reasons for stocks that go up. Coca-Cola, this is very magic. It's a very magic number. Easy to remember. Coca-Cola is earning 30 times per share what they did 32 years ago. The stock has gone up 30-fold. Bethlehem Steel is earning less than they did 30 years ago. The stock is half its price of 30 years ago. Stocks are not lottery tickets. There's a company behind every stock. If a company does well, the stock does well. It's not that complicated. People get too carried away. And first of all, they try and predict the stock market. That is a total waste of time. No one can predict the stock market. They try to predict interest rates. I mean, if anybody would predict interest rates right 3 times in a row, they'd be a billionaire. Considering there's not that many billionaires on the planet, It's very, you know, I had logic, so I had a syllogism and studied these when I was at Boston College. There can't be that many people who can predict interest rates because there'd be lots of billionaires. And no one can predict the economy. I had a lot of people in this room were around in 1981 and 82 when we had a 20% prime rate with double-digit inflation, double-digit unemployment. I don't remember anybody telling me in 1981 about it. I didn't read, I studied all this stuff. I don't remember anybody telling me we're going to have the worst recession since the Depression. So what I'm trying to tell you, it'd be very useful to know what the stock market's going to do. It'd be terrific to know that the Dow Jones average a year from now would be X, that we're going to have a full-scale recession, or interest rate's going to be 12%. That's useful stuff. You never know it, though. You just don't get to learn it. So I've always said, if you spend 14 minutes a year on economics, you've wasted 12 minutes. And I really believe that. Now, I have to be fair. I'm talking about economics in the broad scale, predicting the downturn for next year, or the upturn, or M1 and M2, 3B, and all these M's. I'm talking about economics. To me, is when you talk about scrap prices. When I own auto stocks, I want to know what's happening to used car prices. When used car prices are going up, it's a very good indicator. When I own hotel stocks, I want to know what hotel occupancy is about. When I own chemical stocks, I want to know what's happening to the price of ethylene. These are facts. If aluminum inventories go down 5 straight months, that's relevant. I can deal with that. Home affordability, I want to know about when I own Fannie Mae or I own a housing stock. These are facts. They're economic facts and there's economic predictions. And economic predictions are a total waste. And interest rates, Alan Greenspan's a very honest guy. He would tell you that he can't predict interest rates. He could tell you what short rates are going to do in the next 6 months. Try and stick him on what the long-term rate will be 3 years from now. He'll say, I don't have any idea. So how are you, the investor, supposed to predict interest rates if the head of the Federal Reserve can't do it? So I think that's, but you should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means, that's a euphemism for losing a lot of money rapidly. But we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet, and they're doing fine, and you're hoping to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen. It would be very, people tell you about it after the fact that they predicted it, but they predicted it 53 times. And so you can take advantage of the volatility in the market if you understand what you own. So I think that's the key to element. Another key element is that you have plenty of time. People are in an unbelievable rush to buy a stock. I'll give you an example of a well-known company. Walmart went public in October of 1970. 1970 went public. Already had a great record. It had 15 years performance, great balance sheet. You could have waited 10 years saying you're a very conservative investor. You're not sure this Walmart can make it. You want to check. You see them operate in small towns. You're afraid they can only make it in 7 or 8 states. You want to wait till they go to more states. You keep waiting. You could have bought Walmart 10 years after they went public and made 35 times your money. If you bought it when they went public, you would have made 500 times your money. But you could have waited 10 years after Walmart went public and made over 30 times your money. You could have waited 3 years after Microsoft went public and made 10 times your money. Now, if you knew something about software, I know nothing about software. If you knew something about software, you would have said, these guys have it. I don't care who's going to win, Compaq, IBM. I know who's going to win Japanese computers. I know Microsoft, MS-DOS is the right thing. You could have bought Microsoft. Again, I'm repeating myself, stocks are not a lottery ticket. There's a company behind every stock. And you can just watch it. You have plenty of time. People are in an amazing rush to purchase a security. They're out of breath when they call up. You don't need to do this. It's you need an edge to make money, too. People have incredible edges, and they throw them away. I'll give you a quick example of SmithKline. This is a stock that had Tagamet. Now, you didn't have to buy SmithKline when Tagamet was doing clinical trials. You didn't have to buy SmithKline when Tagamet was talked about in the New England Journal of Medicine or the British version, Lancet. You could have bought SmithKline when Tagamet first came out, a year after it came out. Let's say your spouse, your mother, your father, you were a nurse, you were a druggist, you're writing all these prescriptions. Tagamet was doing an amazing job of curing ulcers, and it was a wonderful pill for the company because if you just stopped taking it, the ulcer came back. See, it would have been a crummy product if you took it for $1 and it went away, but it was a great product for the company. But you could have bought it 2 years after the product was on the market and made 5 or 6 times your money. I mean, all the druggists, all the nurses, all the people, millions of people saw this product. And they're out buying oil companies, or drilling rigs, It happens. And then 3 years later or 4 years later, Glaxo, even a bigger company, it's a huge company, a British company, brought out Zantac, which was a better, at that time, an improved product. And you could have seen that take market share, do well. You could have bought Glaxo and triple your money. So you only need a few stocks in your lifetime. They're in your industry. I think of people, if you'd worked in the auto industry, let's say you're an auto dealer the last 10 years, you would have seen Chrysler come up with a minivan. You've seen, if you're a Buick dealer, a Toyota dealer, Honda dealer, you would have seen the Chrysler dealership packed with people. You could have made 10 times your money on Chrysler a year after the minivan came out. Ford introduced the Taurus Sable, the most successful line of cars in the last 20 years. Ford went up 7-fold on the Taurus Sable. So if you're a car dealer, you only need to buy a few stocks every decade. When your lifetime's over, you don't need a lot of 5-baggers to make a lot of money starting with $10,000 or $5,000. So in your own industry, you're going to see a lot of stocks, and that's what bothers me. There are good stocks out there looking for you, and people just aren't listening, and they're just not watching it. And they have incredible edges. People have big edges over me. They work in the aluminum industry. I see aluminum industries coming down, inventories coming down 6 straight months. They see demand improving. In America today, it's hard to get an EPA permit for a bowling alley, never mind an aluminum smelter. So when aluminum gets tight, you just can't build 7 aluminum smelters. So when you see this coming, you can say, wait a second, I can make some money. When an industry goes from terrible to mediocre, the stock goes north. When it goes from mediocre to good, the stock goes north. And it goes from good to terrific, the stock goes north. There's lots of ways to make money in your own industry. You can be a supplier in the industry. You can be a customer. This thing happens in the paper industry. It happens in the steel industry. It doesn't happen every week. But if you're in some field, you'll see a turn. You'll see something in the publishing industry. These things come along, and it's just mind-boggling. People throw it away. One of the things I find, a couple of rules I want to throw out that I find useful, excuse me, is a lot of times people buy on the basis the stock has gone down this much. How much further can it go down? I remember when Polaroid went from 130 to 100. People said, "Here's this great company, great record. If it ever gets below 100, just buy every share." And it did get below 100. A lot of people bought on that basis, saying, "Look, it's gone from 135 to 100. It's now 95. What a buy!" Within a year, it was 18. And this is a company with no debt. I mean, this is a company. It was just so overpriced, it went down. I did the same thing in my, I think my first or second year at Fidelity. Kaiser Industries had gone from $26 a share to 16. I said, how much lower can it go? It's 16. So I think we bought one of the biggest blocks ever on the American Stock Exchange of Kaiser Industries at 14. I said, it's gone from 26 to 16. How much lower can it go? Well, at 10, I called my mother and said, Mom, you got to look at this Kaiser Industries. I mean, how much lower can it go? It's gone from 26 to 10. Well, it went to 6, it went to 5, it went to 4, it went to 3. And now, fortunately, this happened rapidly, or I would probably be still caddying or working at the Stop and Shop, but it happened fast. So I was able to, it was compressed. And at 3, I figured out, there's something very wrong here because Kaiser Industries owns 40% of Kaiser Steel, they own 40% of Kaiser Aluminum, they own 32% of Kaiser Cement, they own Kaiser Broadcasting, they own Kaiser Sand and Gravel, Kaiser Engineers, they own Jeep, they own business after business, and they had no debt. Now, I learned this very early. This might be a breakthrough for some people. It's very hard to go bankrupt if you don't have any debt. It's tricky. Some people can approach that. It's a real achievement. But they had no debt, and the whole company at 3 was selling at about $75 million. At that point, it was equal to buying one Boeing 747. I said, there's something wrong with this company selling for $75 million. I was a little premature at 16, but I said everything's fine, and eventually this will work out. And what they did is they gave away all their shares to their shareholders. They passed out shares in Kaiser Cement, they passed out shares in Kaiser Aluminum, they passed out their public shares in Kaiser Steel, they sold all the other businesses, and you get about $50 a share. But if you didn't understand the company, if you're just buying on the fact the stock had gone from 26 to 16, and then it went to 10, what would you do when it went to 9? What would you do when it went to 8? What would you do when it went to 7? This is the problem that people have, is they sell stocks because they didn't know why they bought it, then it went down, and they don't know what to do now. Do you flip a coin? Do you walk around the block? You know, what do you do? Psychiatrists haven't worked so far. I've never seen them running in. The Psychological Psychiatry Fund I've never seen listed for with the SEC to make it through as a mutual fund. So they haven't seemed to help. I've tried prayer. That hasn't worked. So if you don't understand the company, you have this problem when they go down. Eventually, they always come back. This one doesn't work either. People think RCA just about got back to its 1929 high when General Electric took it over. A lot of double knits never came back. Remember those beauties? Floppy disks, Western Union. The list goes on and on. People saying it'll come back. Well, it doesn't have to come back. Here's another one you hear all the time. It's $3. How much can I lose? I've had people call me up saying, I'm thinking of buying this stock at 3. How much can I lose? Well, again, you may need a piece of paper for this, but if you put if you put $20,000 in a stock at 50, or your neighbor put $20,000 at 50 into the stock, and you put $20,000 in at 3, and it goes to 0, you lose exactly the same amount of money, everything. And people say it's 3. How much can I lose? Well, if you put $1 million on it, you can lose $1 million. Just the fact that stock, this may be a reason to research a stock. The fact that stock is 3 down from 100 doesn't mean you should buy it. And in fact, short sellers, people that really make money in stocks, they don't short Walmart, they don't short Home Depot, they don't short the great companies, Johnson & Johnson. They short stocks down from 80 to 7. They'd like to have shorted it at 16 or 22, but they figured out at 7 that this company is going to go to 0. They just haven't blown taps on this thing yet. It's going to 0. And they're selling it short at 7, they're selling it short at 6, at 5, at 4, at 3, at 2, at 1 1/4. And you know to sell something short, you need a buyer. Somebody has to buy the damn thing. And you wonder, who's buying this thing? It's these people saying it's 3. How much lower can it go? You know, now, here's a subject that you probably all talked about. Getting close. Getting close. All right, we'll drop that one out. It's getting very close, so everybody has to go somewhere. So the important thing is you can't get too attached to a stock. You have to understand there's a company behind it. You can't treat this like your grandchildren. No, you have to deal with the stock and say, I understand the company, and if it deteriorates, if the fundamentals slip, you have to say goodbye to it. If one rule you want to remember is the stock does not know you own it. This is a breakthrough. So don't get, you have to understand it and say they're doing well, and as long as they keep doing well, my best stocks have been my 5th, 6th, 7th year I owned them, not my 5th, 6th, 7th day. So you have to understand that and stay with it. And then I'll switch through to my, my long shots. Avoid long shots. I bought about 30 long shots in my life. I've never broken even on one. The ones that are really bad are what we call whisper stocks. And if Arthur Levitt was here, he'd appreciate these stories. But these are the kinds that somebody calls you up and say, hi, Peter, how's Carolyn, how are the kids? And I'd like to talk to you about International Blivet. And what they have in this company is very good earnings. Earnings going to be very, they're going to be big, small. $3, $1 a share. And they keep whispering, they say, what are you talking about? I don't understand it. And these are, now either they're so surrounded by people they're going to run out and buy this stock because it's so exciting, or they think the SEC is listening in, they'll get a shorter term, they'll get 6 months in the camp rather than 2 years in the camp. But whisper stocks don't work. And then I want to conclude with there's always something to worry about. If you own stocks, there's always something to worry about. You can't get away from it. What happens in the 50s, people were worried about the only reason we got out of the Depression was World War II. We got another recession. In the early 50s, they said we're going to go right back into a depression. People worried about a depression in the 50s, and they worried about nuclear war. I mean, back then, you know, the little warheads they had then, they couldn't blow up McLean, West Virginia, or McLean, Virginia, you know, or Charlestown. Now, all these countries that end in STAN, there's 9 of these STAN countries that have come out of Russia. They all have enough warheads to blow the world up, and no one worries about it. When I was a kid, people were building fallout shelters, and we used to have this civil defense drill. Remember this one in high school? You'd get under your desk. I never thought even then that was a particularly good thing to do. You know, they'd blow us, and some people in a hat would all get under our desk, you know. But in the 50s, people wouldn't buy stocks, except for the 80s. The 50s was the best decade, this century of the stock market. And people wouldn't buy stocks in the 50s because they're worried about nuclear war and they're worried about depression. Then people, remember when oil went from 4 to 40 and it was going to go to 100 and we're going to have a depression? Remember that one? Well, about 3 years later, the same experts, now higher paid, oil's now at 10, and they said it was going to go to 4 and we're going to have a depression. And then the Japanese, remember how the Japanese were going to own the world? Remember that one? And that we're going to have a depression? And then about 2 years later, we're all worried about Japan collapsing. And this is the most absurd thing I've ever heard. There's a company with a 20% savings rate, incredible workforce, incredible productivity, and people are saying we're going to have a depression because Japan's going to collapse. And they had, you know, on their prayer list, they lowered Mother Teresa and crippled children, and they were praying for Japan at night. You know, it's unbelievable. I mean, the LDC debt. Remember the LDC debt? Remember that one? All these countries, all Chase had lent their net worth to Brazil, Chile, Peru, and all these other countries, and so and all the other countries. And LD said they were not going to pay it back, and we're going to have a depression. It always ends, and we're going to have a depression, or the Great Depression. We're going to have the Great Depression. I never could quite understand that adjective in front of depression, but the Great Depression, or the big one. The big one's coming. But all these countries, and now I understand. You know, these are called then they were called less developed countries. Now we used to call them underdeveloped countries. Those are all wrong terms. Those are not politically correct. You have to call these emerging countries. You can't use less developed or underdeveloped because that's. In fact, the other day I heard the politically correct term for somebody that's overweight is laterally challenged. That's so there's always something to worry about, and the key organ in your body in the stock market is your stomach. It's not the brain. If you can add 8 and 8 and get reasonably close to 16, that's the only level of math you need to know. You don't know to need the area under the curve. Remember that quadratic equation and an integral calculus and the area under the curve. I mean, whoever cared what was under the damn curve? I mean, you know, but you had to study this. You don't need this in the stock market. So all you have to know is you're going to see, it's always going to be scary. There's going to be always something to worry about. And you just have to forget all about it. Cut it all out and own good companies or own turnarounds. Study them and you'll do well. And that's all there is. And I'm ready for questions.
Okay, thank you very much.
When managing a portfolio, do you pay much attention to the activities of Congress and the regulators?
Did Ed Markey put this one up? I'm not sure. I spend zero time thinking about what's happening down here in Washington, and I spend little time thinking what's going on in Russia or China. I just deal with facts. When the economy's going down, when the economy's going the wrong way, I can deal with that. This whole health care reform bill drove a lot of drug stocks down to low levels, and I could say to myself, well, 60% of Johnson & Johnson's earnings are outside the United States. Their pharmaceutical drug business is all on patent. Nothing's coming off patent. They only have 5% of sales from one product, which is Tylenol, which is already an over-the-counter drug and it's growing overseas. I says, why is this stock gone from 58 to 36? And these companies are already dealing in Japan and overseas with they already have the government controlling pharmaceutical prices. They've dealt with it. So I deal with facts. They might, this year, I thought it was very likely you'd have a bill passed on health care. It didn't happen. They drove the stocks down, but I think the stocks would have rebounded anyway, even if the health care bill was passed. So I don't deal with what's happening in Congress or what's going to happen in the future. I just deal with what's happening in the economy and what's happening in the companies I call.
Thank you. How useful is the financial reporting in the general daily press to you, and how useful should it be to investors in general?
Okay. It has improved dramatically, not just in the press, but also company reporting. 10 years ago, companies didn't have interim balance sheets. It's hard to imagine. They only gave their balance sheet to you once a year. Now they show you quarterly what's happening in their inventories, what's happening in receivables. In the major newspapers, they'll even show types of funds. There are now, I think there's 2,500 companies in the New York Stock Exchange. There's over 5,000 different mutual funds. So there's twice as many mutual funds as there are stocks. At least in the paper day, explains what kind of fund this fund is. So I think reporting has improved. They report earnings. But again, I think if you own auto stocks, you shouldn't be reading the financial part of the newspaper. On Wednesday, the local newspaper, Tuesday some places, or on Saturday, they have a whole 4 pages on automobiles. And they talk about new models. And they say this one stinks and this one's outstanding. They really, if you own auto stocks, that's the part of the newspaper you should be in. You shouldn't be calling your broker 4 times a day to get stock quotes. It doesn't work. Getting up in the morning to look to see how your stock did yesterday is not useful. All this stuff is just a waste of time. If you're adding up how much your stocks are worth, absolute waste of time. You should be looking at the company when you get the quarterly reports. You should be, if you're at the mall, imagine if you were in the retailing industry, or if you're in the restaurant industry, you would have seen Taco Bell, you would have seen McDonald's, you would have seen Toys R Us. I mean, you would have seen all these companies do terrifically well. You would have seen Bombay, you would have seen Tandy with Radio Shack, and you would have seen Radio Shack roll across the country, and pretty soon there were 25 Radio Shacks in every major city, and you said, there's not much room for them to go. But they had a 20-year great run. That's what you're dealing with. You're not dealing with the minutia of today. You're dealing, what's this company doing 2 years, 3 years, 4 years, 5 years from now? And if you're dealing with a cyclical and business is turning around, you wait for signs that business is slowing down. And when you see it, you move on to something else.
Are you concerned about the volatility in the financial markets today? Do you think something needs to be done to reduce it?
I love volatility. I remember when in 1972 the market went from down dramatically, and Taco Bell went from 14 to 1. They had no debt. They never had a restaurant close. And I started buying at 7, but I kept on to it, and it went to 1. And it was the largest position in Magellan in 1978 when it was bought out by $42 by Pepsi-Cola. And I think it would have gone to 400 if they didn't buy it out. I think volatility is terrific. I think these callers are very important. I don't think the market going up 80 points one day and down 80 the next is a good thing for the public. I think that's not a very good thing. But I think all these callers and all these other things, to keep the volatility down each day is important. But the market's going to go up and down. Human nature hasn't changed a lot in 25,000 years. And some event will come out of left field, and the market will go down or the market will go up. So volatility will occur, and markets will continue to have these ups and downs. I think that's a great opportunity if people can understand what they own. If they don't understand what they own, they can own mutual funds, try and figure out mutual funds they own, and keep adding to it. Basic corporate profits have grown about 8% a year historically. So corporate profits double about every 9 years. The stock market ought to double about every 9 years. So I think the next market's about 3,800 today, 3,700. I'm pretty convinced the next 3,800 points will be up. It won't be down. The next 500 points, the next 600 points, I don't know which way they're going. So the market ought to double in the next 8 or 9 years. It ought to double again in the 8 or 9 years after that. Because profits will go up 8% a year, and stocks will follow. That's all there is to it.
We're in the month of October. Beware of the month of October, the witching month for the stock market. What do you see as the outlook for this month, and when do you think the Dow will hit 4,000?
Okay. October has always been a special month. I remember in 1987, I was very, I was very convinced that the market was not in trouble, and I didn't worry about things. And Carol and I had planned this great golf vacation to Ireland, and we were going to visit one course and stay at a little house and visit another, go all along the west coast of Ireland and play golf. And we left on a Thursday night, and the market went down 55 points that day, which was not too good. And the next day we got to Ireland, because of the time difference, we'd completed our day, and I got back to the hotel and I called in. The market had gone down 112 on Friday. And I said to Carolyn, I think if the market goes down on Monday, we're going to have to go back. And so we stayed there for the weekend. And on Monday, the market went down 508 points, and my fund went from, I think, 12 billion to 8 billion. And that gets your attention, in two working days. I said, at the end of this week, I'd be have no fund. Now, there wasn't a lot I could do. I mean, here I was on Monday, because the market didn't open, you know, by 12 o'clock it was, in Ireland, it was still 7 o'clock in New York. So we did spend that day, and we played around golf in the morning, and then we went somewhere and sort of watched the market deteriorate. And I did come back. There wasn't nothing I could do. I mean, just nothing I could do about it. But I think my shareholders, they called up and they said, well, what's Lynch doing? They said, well, he's on the 6th hole, and he's, you know, he's even par up to now, but he's in a trap. This could be, you know, this could be a triple bogey here. This could be a big inning. And I don't think that's exactly what they want to hear. As though I could do something about this damn thing. So I came back home and suffered with everybody else. And fortunately, I was very consistent. The market went down when I ran Magellan. On 13 years, the market went down 9 times, and every time the market went down, Magellan went down. I was 9 for 9, and you know, because it's very important. There's another one of these numbers you ought to write down. If you put $1,000 in a stock, all you can lose is 1,000. I've done that several times, and but if you're right, you can make 5,000, 10,000, 20,000. So this business, you don't have to be right 1 out of 2 times. You can be right 1 out of 4. It's a long time. The times you're right, you know the company's doing well, you know they're doing a great job, and you add to it, or at least you don't sell it, which is a terrible tragedy. So you can make more money on the upside. So I just wrote those out, and I will now flip a coin to tell you where the market will go to 4,000 this year or next year. Heads means it goes up. It's a 2-headed coin. The market will go up in the next year. That's it. That's all I ever know about the stock market.
Well, we have, as you can imagine, many questions about where people should put their money. I'm going to divide it into 2 parts, if you can address it. This questioner intends to put $1,000 yearly into my 4-year-old daughter's education fund. Where should I put it? Invested 1. The other just covers everybody else. What are some of your current market favorites and why?
Well, on the first one, and this is important whether you're investing for a 4-year-old, a 14-year-old, or a 74-year-old. You have to say, what am I going to do when the market goes down? Because I've had audiences like this, larger audiences, and I'll say, how many people in the room are short-term investors? I've never had anybody ever raise their hand. I mean, everybody in the world is a long-term investor until the market goes down. And like in I remember 1990. 1990 was so much scarier than 87. 87, the market just fell down, and you call up companies and said, our business is terrific. We're about to announce a stock buyback, or we're already buying back our stock. Business is great, and we can't figure this out. But in 1990, you had Kuwait invaded. You had the banking system really on the ropes. I mean, really close. You called up a company and they said the business was slowing down. We sent 500,000 troops to Saudi, and we were about to fight what people thought was the remember, it was the 4th largest army in the world, and they were the toughest army in the world, and this was going to be a terrible war, and that we ought to sit them out. Remember the theory, the big theory, there's a lot of people in this city saying, we ought to wait them out. You know, we'd still be waiting there at 120 degrees with our 500,000 people. I mean, I think Bush made an incredibly brave decision on the information he was getting to go in there and knock them out, or we'd still be there. But that was an ugly time, and that was very scary, and the public stood up. Some people learned from 87, and they stood throughout that and said, I'm confident about the next 5, 10, 15 years of this country, and they hung in there. So I would say if you want to buy a small growth fund, or you want to buy a balanced fund that's part bonds and part stocks, you can put so much money in, put more in every year, you'll be very pleased in 10, 20, 30 years. Stocks will beat the hell out of money markets. They can beat the hell out of bonds. No group of, you think of it, any corporations, McDonald's, any of these great companies, Marriott, you name it, they've never got together and said, geez, you know, we're really doing well. Why don't we raise the coupon on our bonds? You know, those bondholders have been really loyal. We've been given 8%. Why don't we raise it to 9? You know, but companies like Automatic Data Processing, they do payroll. It's an amazing, prosaic company. 32 years of higher earnings. 32 years of double-digit earnings growth. We've had recessions, we've had wars, we've had changes in Congress, changes in the Supreme Court. 32 years of up earnings. So, I mean, that's what you're relying on. Johnson & Johnson, 30 years of up earnings. I mean, these are General Parts, 42 years of up earnings. Emerson Electric, 38 years of up earnings. You don't see companies like this in other parts of the world. So I think that's what you buy when you buy a fund. You're buying a bunch of good companies. And And the second question was what again?
Just your...
The stocks.
bets
Well, I think the financial area has been hurt heavily in the stock market. I think that's an attractive area. Stocks like Chemical or Travelers or Citicorp or Bank of Boston or Fleet or Shawmut, Fannie Mae, Freddie Mac. These stocks have all come down. Their business is terrific. They've improved their balance sheets. They're selling at multiples half or one-third lower than the general market. I think the cyclicals. I think we have a chance for the cyclicals for the first time in a long time. The steels, the papers, the aluminums, the chemicals. I mean, it's their turn to come to the plate, and there's going to be a good time the next... we seem to have an economy recovering in Latin America. Brazil is turning around. These are facts again. When you hear these facts, these countries are really... India, I've been visited India. Things are really improving in India. Europe had the worst recession since the Depression. There's 18 million people out of work. 18 million people out of work in Western Europe right now. And the economy's starting to slowly turn. Japan has bottomed. So I think you're going to see a demand. And commodity prices have been... Aluminum prices got to 30-year low. Now ingot has almost doubled. You're going to see the same thing with linerboard. So you're going to see a very good time for cyclical stocks. And I think the auto stocks are also extremely cheap at 4 or 5 times earnings. I think the economy is going to be, my opinion, from the companies I talk to, in the business I look at, things are not off trend line. These are not extraordinary times. Housing is very affordable. It's not as affordable as it was 2 years ago, but on a 20-year basis, housing is very affordable. Automobiles are very affordable. Consumer durables are very affordable. I think people are going to, and we've added, as you know, I still don't understand when we hear the job growth. We've added, in the recession we lost 1.8 million jobs, and now we've added back 5.8 million, 4.5 million in the last 19 months. So we lost 1.8 and we've added 5.8 back. We're 4 million to the good. Tough part of it is we dropped about 600,000 manufacturing jobs, and we've only brought back 100,000 manufacturing jobs. But there are a lot more people working, and I think that trend's going to continue. And in the decade of the 80s, I think this is key. The decade of the 80s, this is what you hear from the press, this is what you hear from TV. In the decade of the 80s, the 500 largest companies eliminated 3 million jobs. 3 million jobs. But there was 2.1 million businesses started in the 1980s. And if they just have 10 people each, that's 21 million jobs. This is an incredible job machine we have in America. So that's what happened in the 80s. These 2.1 million businesses created all the jobs. And the decade of the 90s, the top 500 companies are going to eliminate another 3 million people. And all you ever hear about is Company X lays off 5,000 people in Hartford, and Company Y lays off 5,000 people in Rochester, and somebody doesn't buy a sofa in Scottsdale, Arizona, because they're reading their newspaper about another layoff in the Northeast. I mean, that's the nature. These companies have to do it to stay competitive. That's our business. And we've had, in the last 2.5 years, been a phenomenal, this has been a great thing for our country. We've had 1,750 companies come public. They've raised over $100 billion. There's only 2,500 companies in your size change. 1,750 companies is a lot. They're going to put this into research and development. They're going to put it into more plant, more efficient equipment. This is a fantastic thing for these companies. So I think the situation is excellent. The banking system, for the first time since the early 50s, a lot of people follow the banking industry. The banking system today has more investments on the left side of the balance sheet. You talk about the governments they own, the mortgage-backed securities they own, than they have loans. First time ever since 1951. And they're only making 50, 20, 30 basis points. They said, love to make loans. The banking system has the highest equity to assets in 45 years. The banking system is ready to go. There's lots of liquidity around. I don't know why people are so depressed about people getting hired all the time. I can't quite figure this out. I don't know. I have never met a banker, anybody in business that likes recessions. I've yet to find these people, you know. So I think it's very good the economy's doing well.
Well, speaking of banks, are you concerned about banks being allowed to offer mutual funds and the confusion that creates among investors over whether bank deposits are insured or not insured, or how much is insured, or the whole question of deregulation? Okay.
No, I think it's very positive. Banks are be allowed to sell mutual funds because they'll probably sell a lot of Fidelity mutual funds. That's very important. No, but seriously, I think it's very important that people understand when they own a bond fund that bonds can go up and down. Bonds are just about as volatile as stocks. And if they own a 30-year bond fund, that you can lose 25, 30% of your money very fast, even though they're government bonds. People have to understand this. There's an incredible rate of illiteracy in our public, and all they ever hear about is what happened today to Bristol Myers going up $2 or $3, what happened to Dow Jones. They don't get to learn anything about America. And people at some point in their career are presented, they're near retirement, they're given $450,000, $500,000 because it's an early retirement. They have no experience. They don't know what a bond is. They don't know what stocks are. And they have to make a decision in 30 or 60 days or they have a big tax consequence. These people have had no experience learning about the stock market. It's a tragedy. So I think anything we can do to educate the public, if you can convince people, if they understand the volatility of the stock market, I'm not saying anybody should buy a stock. I'm just saying if you purchase a stock, you ought to do certain things. If you purchase a stock and do certain things, you will do better. If you're not ready to do those things, you should keep your money in the bank. Keep your money in a money market fund. Some people aren't willing to do the homework. They don't have the stomach for it. They should stay out. They're not doing anybody any good by taking half their life savings and putting in the stock market. Or they've been lucky enough to save $50,000 or $60,000 to send their kids to college, and one's going to start in a year, and they're going to take all that money and put it in an equity mutual fund with a one-year horizon. That's doing no one any good. So I think the more, whether it's the banks that explain it, the brokers that explain it, anybody that does, and we're working on this at the SEC is working very hard on this to explain to people the nature of these products. If they understand them, they'll do better with it. More information, the merrier. Fidelity's launching a major study. It'll be out the end of this year on retirement. We've interviewed over 1,600 people, over 300 experts. We're going to put a major study on trying to explain to people about nature of retirement and how they can best understand how they should invest their assets. We're not going to mention Fidelity at all, of course. It may be subliminal in it, but we're trying to help. And the more we can do this, and there's been an incredible push by the SEC to do this, and I think it's a very positive element.
A couple of questions about that. What do you think of the SEC's proposal to require mutual funds to adopt a quantitative rating scale for riskiness, number one? And what effect do you feel that the new shareholder rights proposals for more open disclosure and communication are having on companies and the markets?
Okay. On the second one, I'm not too familiar with the first one. On the second one, I think you have to be careful in crossing the bridge on how much we get involved in managing companies. I think there should be disclosure of what people are getting paid. There should be disclosure of how many shares they own. But I don't think we should be deciding whether they should make this acquisition or whether they should expand this plant. When you get too involved in running a company, it's very complex. And a lot of great companies have made a lot of decisions you haven't heard about because they decided not to do something. Some of the best decisions they didn't do was to not do something. And if they're under all this pressure from shareholders of what to do and what not to do, they're going to take their eye off the ball, and they're not going to be able to run the business. And companies are doing well because the companies do well, look out 5, 6, 7 years, and some of the decisions they make may not be the right thing for the next year. The more and more we concentrate on what they're doing and we keep commenting on as outsiders, it's going to be run by an enormous committee, and we'll get committee results. So I don't think that's going to help anybody. But disclosure of relevant facts, of how many options people have, or the options at the market, what they're being paid, I think that's important, how many shares they own, what the company's doing. I think they used to not have a letter. I mean, it's not that recently that you have comments by the chief executive at the stop and hand report. They never used to have to make that. There's a letter saying what happened. I mean, it really is a very valuable piece of information. You don't realize this company spent a lot of time on this. This is a very serious document. I think it's very helpful to shareholders. The quarterly shareholder reports are excellent. And also, I've stressed, everybody in America can get a hold of a company. It's not Fidelity and Putnam and Dreyfus. You can get a hold of a company if you own 100 shares. You can call a company, somebody will talk to you about it. People don't take advantage of that. These companies are willing to talk. On this quantitative and qualitative risk ratings, I think if it could be done, I think it might be positive. I'm a little confused on it. I'm not that up to date on it. But I think people should understand, that certain stock funds, emerging growth funds that invest in companies that have 50 million or sales, and very small, are much more volatile than when you're buying major quality blue chip growth companies, and that long-term bonds are more valuable than medium-term bonds, which are more volatile than one-year bonds. I think these are things that should be explained to people. people should get a menu like you get at Howard Johnson's.
Well, before we run out of time, and for Mr. Johnson's benefit, several people in the audience ask, how do you view Fannie Mae's stock and options today?
Okay. Well, I think I'd broaden it to Freddie Mac, too. I think both of these companies, you know, have a great business, and I always look at the stock market, I think of it more, if people study chess, this would be not a good game to study for the stock market, because in chess, an outstanding player will beat a good player 1,000 times in a row. Everything's in front of you, all the moves are known, it's all technique. In poker or in bridge, there's a lot of uncertainties, there's a lot of things you don't know. You can play a hand exactly right and lose. You say, well, I played it right, if I do it again over a night, over a month, I'll do it. That's the stock market. The stock market is much closer to poker than it is to than any other game. And I think that's what's the important thing to know. And what the hell was the question? Fannie Mae. Fannie Mae has been sort of like a 27-card stud poker game, you know, over 12 years. Cards keep getting turned over, like we're not doing so well in Houston, and this is 10 or 12 years ago, and with these 5% downs that a lot of people had in mortgages, and people moved there for jobs, and the job, they brought their spouse along there, and the job left, they had no ties to those communities, and they left, or in Oklahoma or in Alaska. So when that card turned over, it was kind of ugly. And then they were losing $1 million a day. That was easy to remember. That wasn't too pleasant. And what they finally figured out was we have a very good business. We're extremely low cost. And if we can match our liabilities and our assets, make a very small spread, but we have very low costs, we can have a pretty good business. And then a card would come over like real estate prices started to go down in California. They started to go down in the Northeast. And then you had to say, well, I better keep checking to see what foreclosures would be like. And you must own, that doesn't own any Fannie Mae. But so anyway, so all these things, if you keep watching the story, every year you get a chance to buy this again. Because something will come up. People were worried that rates were going to go down. So the stock went down because rates are going down. And then now interest rates gone up, the stock's going down because interest rates gone up. And Freddie Mac and Fannie Mae are still doing great. And I think they're going to be terrific stocks. I mean, they're not going to quadruple, but I think they're about 25% undervalued now, and I think it'll be good stocks to own for 5 years.
It's my pleasure, Mr. Lynch, to present you with a Press Club mug and a certificate of appreciation before I ask the final question.
Uh-oh. Try to drink coffee.
Here's a fella has a problem. He says, well, if the real secret of your success is following your daughters to the shopping mall for stock tips, what do we bachelors do?
Well, I think on the weekend, I think one of the reasons people get so depressed is they get away from children. On the weekend, they read all these magazines, they read the newspapers, and they can become economists, and they get so depressed. I mean, they're bullish if they take their lunch to work on Monday, you know. And I think you need to rent a 12-year-old on the weekend, just to, because they don't know about the problem of the ozone layer disappearing and all the problems of, you know, all these terrible things that we think about all the time, you get so depressed about, and how second basemen and shortstops that are getting paid $4 million and they can't throw it to first base on a bounce, you know. So I think you need to find a 12-year-old and rent them for the weekend and follow this boy or girl around and see where they're shopping. And our kids love Body Shop, you know, and I bought it, and I think it's going to be a good stock. And our oldest daughter, Mary, liked Ann Taylor, and she had to dress up to go to work she was working in the summer at a consulting firm, and she thought Ann Taylor's prices were good and the quality was good, and it was a great stock tick. And my wife, Carolyn, who was till we had these 3 kids, she's an extremely good shopper. She almost got a black belt in shopping. She didn't fit, because of the children, she didn't quite finish that, but she's a very good shopper, and she's given me some great tips too. So I think you either have to use your spouse, or you have to go out on your own. I had this biggest position in my fund one time was Hanes, which owned Legs, and was a huge stock, and it was bought eventually by Consolidated Foods, and it was the best division of Consolidated Foods. But it was my biggest position, and they had a monopoly on this Legs, and Legs is a really big hit. And I knew somebody would come along with a new product, and it was Kaiser Roth introduced No Nonsense. And I was worried that this thing was better, and I couldn't quite figure out what was going on. So I went to the supermarket, and I bought 62 pairs of No Nonsense, different colors, different shapes. They must have wondered what kind of house I had at home when I was going back. I brought it in, I brought it to the office, and I passed out to anybody, male or female, anybody wanted these things. Just take them home and tell me how it is. And they came back in about 3 weeks, and they said, it's not as good. And that's what research is. That's all it was. And I held on to Haynes, and the stock was a huge stock. So that's what it's about. Thank you.
Thank you, Mr. Lynch, and thank you all for being with us.
All right. I apologize.
Oh, yeah, no.
It was your Great book.
Oh, thanks so much. Good meeting you.
Thanks again. I hope you have a great lunch.